I'm going to cover 5 stocks that I'm buying right now. I'm buying heavily the last couple of days. Before I do that, I want to talk a little bit about the psychology behind investing. I think that it can be really hard, especially if you're a newer investor. Now, really, anybody that came in the market since the pandemic 5, 6 years ago, you haven't really seen kind of a normal market. And of course, we're always learning. I've been doing this almost 3 decades and I'm learning every single day. But I think it's very hard for a newer investor, especially if you come in the market the last couple of years. You've seen enormous bull runs in these tech stocks, and you probably haven't seen a rotation before. You probably haven't seen tech stocks sell off and people go buy blue chips, or narratives like, hey, all software is dead, sell everything. It doesn't matter if it's good or bad. Just throw the baby out with the bathwater. One of the biggest challenges in investing is the psychology. And how you can overcome that psychology is by having conviction in what you own. In other words, the way to look at it, if you own shares of stock, you're a part owner of that business. You own a piece of that company. If you want to own that company because you think it's going to be worth more in 3, 4, 5 years, you're not really worried about it if there's some gyrations in the stock price. But if you're one of those people that maybe copy trade, they go on to YouTube or X and say, well, this person seems like he knows what he's doing or she knows what she's doing. I'm going to go buy this list of stocks from the video or from the post or whatever. And the problem is that person might own 30 stocks and they might have a small position, and you might pick 1 or 2 of those stocks because they have the most upside, the most bang for the buck. I get people ask me every single day, hey, which stock can I buy right now that has the most upside? I want to double my money in a couple months. The problem with that mindset, you're trying to get rich quick, you almost always lose money. Now, I've got nothing against traders if that's what you want to do. I focus personally on long-term investing. And the main reason for that is it's the only cheat code there really is to beat the street. If you know a company is doing good things and it's going to be worth more in 3 to 5 years, you can buy shares today and not really worry about it. But that sounds a lot simpler than it actually is. So if I look at these SaaS companies selling off, just as an example here, the SaaS apocalypse. And a lot of people in software will tell you that this is unwarranted. Now, I was in software for a decade and I'm on the side of the fence that thinks this is unwarranted. There are a lot of good companies. You're going to need the backbones. Each segment of software is going to have 1 or 2 leaders, and you're trying to focus on best of breed. And there's really the 3 pillars. You want to avoid the application type software, but focus more on those mission critical core enterprise companies. Now, recently in the private community, I did an hour podcast that broke down the different pillars of software that I would personally want to own. And for me, that's going to be cybersecurity, as well as specific data stocks, and then those enterprise backbones that enable agentic AI. Now, looking at JP Morgan here, they came out with 19 stocks to buy amid AI disruption fears in software. I've been buying Microsoft, ServiceNow, not these necessarily, not saying you can't, the Palo Altos, the CrowdStrike, Zscalers, those are my 3 favorite on this list. I would also add Cloudflare or Net, Snowflake, Guidewire, Datadog. Well, I kind of did some of the work for you. You can see I circled and X some of those. You go into Eric's watch list, and there's that whole list of stocks from 2023 for best of breed. Now, I just gave you a list, and I don't want you to go and buy the stocks because you saw them on a list on a video. You need to study these companies and have conviction, and not just in the companies, but the high-level thesis too. Is AI really going to disrupt? How does all this stuff work? How does enterprise software even work? If you don't understand that stuff, you might not want to invest in these companies. I tell most people they should completely avoid SaaS. Don't even buy it at all. And if you do buy it as spec. Now, if you have a deep understanding of software, it's a different answer. But most people watching probably aren't in that camp. You can see here, this is from the founder and chairman of Constellation Research. The way they're being undervalued makes no sense at this moment because I think people are overreacting, saying that software is going to go away with AI. But not all software is going away with AI. We know that. This is true. In fact, AI is just a form of software. He pointed to companies like ServiceNow, Salesforce, and yes, you might buy these and they go lower than you think. That's going to happen when sentiment goes to zero. Everybody throws stocks in the trash. And it's okay if you own a company, if you believe in it, if it's down in your portfolio because you're thinking about 3, 4, and 5 years. The biggest problem is that a lot of you might not have that mindset. You're still in that trader mindset. What can I buy today? I've got $2,000 Let me try to flip it for 3,000, buy something else and flip that from 3,000 to 5,000, and I'm going to build $1 million portfolio overnight and get rich quick. I'm here to tell you, sorry to be the bearer of bad news, but it just doesn't work that way. Now, we could cover a lot of different stocks today. I'm going to give you some ideas that I'm not actually buying, a couple that I even own, but I'm not buying right now. And so I could talk about a number of companies that you see in your screen. The one I want to focus on right now, though, is Microsoft. Now, Microsoft's AI head said the company is pursuing true self-sufficiency in AI by developing its own powerful models and reducing dependence on OpenAI. Now, this actually should be seen as a good thing because the market's been saying OpenAI is no good and that Anthropic's going to replace it. OpenAI is going out of business. And yes, at one point, Microsoft owned 49% of OpenAI. I think now it's something like 29%, but I don't think OpenAI is going anywhere anytime soon. And you know, if you follow tech, that companies are often going to partner and compete in the same space. That's nothing unusual. We have to develop our own foundation models, which are at the absolute frontier with gigawatt scale compute. Now, of course, some of these Mag 7 stocks are selling off because of the huge AI capex that we're seeing. We just had earnings season for the mega cap tech companies, and we're talking about massive 97%, 60%, 135% increases in AI capex spend. You know, $655 billion, $700 billion expected to be spent just this year alone. A little bit of a teaser for Saturday's quantum computing video, but if you think about the TAM in 2030, what the actual total addressable market is, I won't give you the number, but I'm going to tell you it's very, very small compared to the numbers you're seeing on your screen. But yet those phase one infrastructure stocks, a lot of them are being thrown in the trash. We'll talk about one of my favorites later in the video. Looking at some of these metrics on Seeking Alpha, I mean, we got an A+ profitability grade, 68% gross profit margin, very strong numbers across the board, bringing in about $523,000 net income per employee TTM. The growth, well, guess what? It's not a hyper-growth company. This is a DGIF. It has that dividend that compounds. I've owned this stock since 2012. The fact that it's still showing you 15 and 16% revenue growth with this size of market cap is actually unreal. We're talking about a forward PE gap, 23.5, a PEG gap TTM under 1 at 0.88. So I posted this on social media. I think it was on Facebook. And I posted that Stifel downgraded Microsoft. It says that AI spending and Azure concerns could limit near-term upside. I don't care about near-term upside. I'm a long-term investor. The market and its analysts care about one thing, and that's right now. Maybe 6 months in the future, not 6 years in the future. And this is your cheat code as a long-term investor. And really being a long-term investor is a cheat code in itself. Microsoft, keep selling. I'll be buying. I posted this on social media, first comment. You're buying Microsoft for long-term? Isn't that literally what I just said? Yes. And then you get another comment. I don't agree. AI is going to replace software companies like Google and Microsoft. Neither will exist in 10 to 15 years. Do you really believe that Google and Microsoft won't exist in 10 to 15 years? I worked in software for 10 years, and I can tell you how slow adoption truly is for enterprises. And yes, AI is doing amazing things and doing it quickly, but that's why we invested in those phase one infrastructure stocks all the way back in 2022 and 2023. We've been absolutely printing money with those stocks. The NVIDIAs of the world, the Broadcoms, the AMDs, the Microns. Even when you look at the ontology and the data layer, Palantir, I buy at $10. You know, now Michael Burry's coming out saying, you know, oh, this is trash, sell it when it's $150. He didn't have the foresight to tell you to buy it at 10, but he's going to bash it at 150. Now, I'm not saying it's not expensive, but the point is we were way ahead of this curve. So I'm buying Microsoft under $400 DCA. Now you can see here this S2 is 404, S3 Fibonacci $378.32. You know, if you look at April 2025 lows, you had $342.95. So $343. This thing ripped from $343 up to $552, double top. And can it go lower? Sure. I mean, $342 is probably a pretty good floor if it retests the April 2025 lows. But I'm buying shares right now at $399. I'll buy some more at $375 and so on. I'm thinking about long-term investing. And Microsoft, for me, it's like a 5+ year holding. And of course, I'm going to buy, hold, and monitor. It's never a buy and hold forever. So hopefully you've watched the entire video to this point, because if not, it won't really make sense if you skipped ahead. You might be playing checkers while we're playing chess. And again, it goes back to long-term investing, a disciplined mindset, which isn't easy to do. It takes a lot of experience to get to that point. One of the key things that you'll learn from the Masterclass series, it's going to talk about the different types of stocks, the psychology of long-term investing. First and foremost, you have to understand how to build a blueprint. You have to know how to manage risk, how to construct a blueprint based on secular trends. If you just buy a handful of stocks, again, off of X or YouTube, you're probably going to lose money. You're also going to have massive beta. And if you have massive beta, it's going to be very hard for you to manage the psychology of that, especially if you're newer to the markets. So when we look at the life cycle of a company, you have spec, hyper growth, mature growth, DGIF, DGI, and income. Where you buy a stock within that life cycle will determine the beta. In other words, the volatility, how much the stock goes up and down. Everybody wants to chase alpha. That means returns, beating the market, getting rich quick. But nobody wants what comes with high alpha, which is almost always high beta. So if you invest in a high beta stock, like the one I'm about to cover, so if you're okay with the alpha and you buy a stock at 47 and it goes to $260 overnight, you'll also have to accept the beta and the fact that it can go from $260 back to $100 overnight as well. And if you don't understand that, don't invest in high beta stocks like Astera Labs. Now, some of the comments are ridiculous. I want to remind you guys, this was a buy in the community portfolio. The cost basis was in the $60. Started buying at 90 all the way down into the 40s. When it ripped to 200 plus, we trimmed half of it. We took profits. We went to house shares. We literally can't lose money on the stock. So we're sitting on 100 shares in that community portfolio with a $63 cost basis. When it ripped up to 250 plus, we talked about that 50% retracement, where it'd be an opportunity to get in the stock when it comes below 150. And when we talk about that, we're talking about DCA. And we also understand there's massive risk, the downside and upside, both directions. So Astera Labs had a great earnings report, up 91% year over year in the revenue, non-GAAP EPS of 58 cents, beat by 7 cents. So if the earnings were so great, why is the stock down? Well, first and foremost, it's a high beta stock. People taking profits from last year. You're going to have options traders that are going to make that momentum go one direction or the other. Right now, the direction's down. Eventually, they'll switch gears and go back to bullish and the direction will be up. You're having a rotation out of tech overall. Now, what's funny about it, as I mentioned this earlier, these are the type of companies that you should actually be buying if you look at $700 billion of AI CapEx. A lot of great things happen on this earnings report. So in Discord, I always keep you up to speed with what's going on. The initial reaction was from traders because of margin headwinds. There are these warrants with Amazon. This is a good deal for ALAB longer term, $6.5 billion Amazon commitment, but management expects a 200 basis point or 2% hit to gross margins. This is also why the stock had some volatility the last time it reported earnings, if you remember. Now, if you look at the analyst price targets on this, I'm not saying you go buy because of analyst price targets, but yeah, they're lowering it from 215 to 205. Hey, 205, I'll take that. Well, here's another one. Buy rating and $220 price target. Does that mean if you buy it at $140, it's going to instantly turn around and go to 220 tomorrow? No, that's not how it works. Here's another one from Citigroup, lowering the price target from 275 to 250. These profit margins are really strong at 75%. This shows tremendous pricing power for what it is. This is not a software company where it has those 90% margins. You're talking about semiconductor and related equipment. This is a very high margin. In fact, it's higher than NVIDIA's. NVIDIA's at 70%, and they have amazing pricing power with their GPUs. You know, this is a small company with 700 employees right now. They are expanding into Israel. They're going to have an R&D center there, and they're hiring hundreds of employees. But right now, you're talking about $500,000 net income per employee. Growth is off the charts. You saw 100%, you see 60%, big numbers from ALAB. The problem, of course, is it's expensive. It's going to carry a premium because of that growth. So this is a forward gap of 88. That means it could get a lot cheaper. It means if it's $130, it can certainly go lower because the PE ratio is an 88. And yes, you have to use a PE ratio because this isn't recurring revenue like software or SaaS. So 18 price to sales is not a cheap stock. Again, the cost basis in the community portfolio is $63, not $132. Do I think it's a buy here? Yes. Can it go lower? Yes. It's the same thing I've been saying. DCA under $150. The lower, the better. High beta name, not for the weak stomach. If you got a weak stomach, low risk tolerance, do not buy Astera Labs. This thing could go to $90 to $100. In the extreme case, so always keep that in mind. It's trading at $132. You know what I actually did today? This main portfolio that's around $3 million, I've been de-risking this. But I actually bought Astera Labs. I'm going to count this as a spec stock in this portfolio because the risk tolerance is a 6 out of 10. But I don't want to go overweight in the community portfolio. We already have the blueprint baked out for that portfolio, and I want to buy some more. So I bought some at 140, and it's going to go lower. And I even told the group, short interest is 6.54%. Expect lower. S3 Fibonacci, 122.51. Wouldn't be shocked to see $90 to $100. Long-term holding, 3+ years. Remember, long-term investment. Very small position. Right now, it's 0.17% of the portfolio. And I'm looking to add. So I've got another limit order. I'll buy another 50 shares if it gets down to this S3, 122. If it goes another 10 bucks lower, I'll buy some more. I'm confident that this company is going to be worth more in 3 to 5 years. Now, with that said, the total addressable market that's self-identified for management is 25 billion. The market cap right now is 22.4 billion. So yes, it is expensive, and yes, it can go lower. Here's the S3 Fibonacci, but I think it can go as low as 90 bucks. So if I update our risk reward here, here's your downside potential, and it can always go lower because we just saw $47 here. This is April of 2025. Astera Labs ripped from $47 to $263, and now it's trading at 130 bucks. A 50% retracement. So you're expecting that it's going to come in this circle, and this is where you buy. You don't chase up here. This is where you trim. You buy here. You trim here, 50% retracement, you buy again. But it's going to take some time to consolidate. And yes, it can go lower. With time, it's going to eventually find a floor, and it's going to go back up to $190, $200, maybe even more. Maybe all-time highs at 300. It might take 2 years. I'm okay with that. I've got time. I'm a long-term investor. If you're a trader, well, this isn't momentum right now. It's the opposite of momentum. People are shorting it. Wait for the momentum to go and go buy then. You say, well, why don't you do that all the time? Because dollar cost averaging works, and I've proven it time and time again over 25 plus years of investing. So I'm going to do what works for me. Always do what works best for you. Another stock to buy for long-term investors, Netflix, down 25% in the past year. You got A+ profitability metric here on Seeking Alpha. 48% gross profit margin, pretty good for what it does, streaming, right? $686,000 net income per employee, which is very healthy. Growth, you're talking about 15%. This isn't hyper growth at this point. It's a growth stock. Valuation, not dirt cheap, but hey, 25.51 gap forward P ratio with a 1.13 peg gap. That's not bad at all. The S3 Fibonacci is $74.32, getting really close. Also getting close to this trend line. This is a great area, especially if you haven't bought the stock already. This is a great area to start adding if you don't already own it. And I started buying it higher, and I'm DCAing, and I'm trying to be very, very disciplined and not buy it unless it goes below $75, but that's really hard because it got down to $75.32 today. So I had my limit order in. Of course, you can always pay 32 cents more. It's not that you can't do that, but I put a limit order in at $74.97, and I spent the entire day making this video. So if I'm down like 10, 12% on Netflix, I'm not really sweating it. Again, long-term mindset. This was a $134 stock. Is it going to rebound tomorrow and go back to 134? No, it might take a year or two, but even if it does, that's great profits, and it's going to outperform the S&P 500, outperform the market. When people are going nuts and you have these huge air pockets, this is when you want to avoid buying stocks and or trim stocks. When the air pocket gets collapsed and it's getting down to these longer term trend lines, this is the area that I like to buy stocks. But it seems counterintuitive again if you're in that trading mindset, because you want to buy momentum, not when everybody's thrown away. This is FOMO, fear of missing out on the upside, and this right here is full fear of losing everything. Oh, it's going to go lower. I'll buy it when it goes to 50. This is the psychology of investing that we talk about every single day in Fired Up Wealth. Another great high quality swan stock, sleep well at night. This is a mature growth company. Probably pays a dividend at some point, similar to like a Google or a Salesforce where they just started paying dividends recently, a Meta. Gross profit margin 50%. Of course, this has the retail. It also has the cloud services. Amazon is an octopus with all kinds of tentacles going every direction. Growth on this is pretty solid for a mature type growth company. I consider mature growth 12% is a solid number. Now, valuation wise, 26.36. That's not dirt cheap, but for what you're getting, especially if you think, is Amazon going to be worth more in 5 years? I think it will be. Are you going to get rich quick owning Amazon? Of course not. So if you're just chasing alpha and you're saying, I got $2,000, I want to buy one stock that's going to double overnight, this is where you get in trouble. This is why you got to build a blueprint and buy a bunch of different types of stocks, not one type of stock, not all spec, not all hypergrowth, not all dividend stocks either. You want a blend of all these things. This stock's down 12.78% in the past year. Why? This is one of the best companies to own long-term for AI, for cloud services, for streaming, potentially robo-taxis with Zoox and drone deliveries and much more. So I personally have very high conviction in Amazon. The question is, do you have high conviction? Because that's what matters. You can't borrow my conviction. I'm a buyer of Amazon below $200 DCA. Can I go lower? The answer is always yes. In April 2025, this was $161. So could it get to 180 before it bottoms out? Absolutely it could. But that full mindset stops people from buying because they think, what if it goes lower? What if it goes lower? I'll wait till it goes lower. But then when it's a $250, $300 stock in a couple years, you're going to say, man, I wish I would have bought more when it was below $200 a share. But the psychology behind that, well, it's not easy. So if I look where it's trading at now, of course it can always go lower. This is 185 here at the bottom of this red. Up here, we're rocking something like 260 bucks. This is your upside. This is your downside. And of course, the downside is always lower. So if you want to be really conservative, say, well, there's your downside. Of course, it can always go lower. If you're trying to time it, good luck. For me, Amazon is a buy, $200 or less, DCA, dollar cost average. Up next here, I'm going to share two stocks that I'm not buying right now, but I think they should be on your radar. And I do own both of these stocks. I think if these come a little bit lower, they get very attractive. And for the right blueprint, they could be a buy right now. This first one is Applovin, ticker APP, $375 after earnings. It's down about 18%. So this has dropped from like 670 bucks to 375. But keep in mind, it was close to $200 during the sell-off in April 2025. So I got down to $200.50, April 2025, ripped up to the 745 level, kind of like a double top again, and dropped off a cliff. Now this S3 Fibonacci is 319.48. I think you could easily see this stock in the 200s, maybe the high 200s. So if this gets closer to $300 or below $300, this is where it gets really attractive in my opinion. We do own this in the community portfolio at about $225 a share. And then the second one here is Shopify. You can see it's down about 8% at 109. The 52-week high on this was $182.19. Now neither of these are cheap, which is why I'm not necessarily buying them right now, but I think they should be on your radar. You know, Shopify, the S3 is $103.72. If this gets below $100, that's where it's harder to ignore. Another stock though, again, guys, that ripped from under 70 bucks in April 2025 up to 180 plus a share. We were trimming some like 150, 175, saying, hey, this is getting a little bit frothy here. So you have your kind of 50% retracement, a little bit more with the tech sell-off. You know, could it get down to $100 a share? I think so. If it gets to that level, it starts to get attractive. And then there's three dividend stocks I'm buying. This first one here is selling off, and I think it's unjustified for how much it's selling off. You know, this is paying about a 2.5% dividend with 26 years of dividend growth. And as always, I keep you up to date in Discord. And I think this reaction to IBM stock, it looks overdone. Specifically to IBM itself, because if you look at what's going on here, this is an SEC probe into the accounting and cash management practices for this spin-off company. IBM remains uninvolved directly. It's important to understand that. It's a little bit of a knee-jerk reaction off this headline, plus the fact that software and tech names are just selling off. So this is one of those that's selling off more than I think it should. It can always go lower, but if I look 8 to 12% decline for a reasonable guilt by association penalty, we're in that box right now. So in the dividend portfolio, I bought over $20,000 of IBM today, and it's trading at 260. Some of my shares are even lower than this. I think I got some around 257, 258. But you can see you're below the moving averages. You're below this S3 Fibonacci's 272. You know, valuation-wise, 25. So you could argue it's expensive, and it can always come down lower. You start looking at pegs and things like that, though. This is a pretty attractive stock, especially considering the dividend. The lower the stock, the higher the yield. This next one's paying a 2.52% dividend, 22 years of dividend growth, selling off a bit after recent earnings. This was a $205 stock. Got down to like 132. It's trading at about 138 right now. This is Qualcomm. And this final one pays a 2.83% dividend, 15 years of dividend growth. I also bought some of this today in the dividend portfolio at $216, $217. It's Accenture, and you can see it's below all the moving averages, the Fibonacci's. We're even lower right now than the 2022 bear market lows. If you're new here, make sure you subscribe. Click the bell for notifications. If this video helped you at all, please return the favor and drop me a like, drop me a comment. Thanks for watching. Have a great rest of your day. Take care.